Okay, guys. Now we calculated our terminal value. Then, from after calculating terminal value, as I told you, we can get our total cash flows. Then I hope all of you can remember. I told you our discounted cash flow method. This mainly the value under the discounted cash flow method. It is driven by based on two factors. First one is the free cash flow. Second one is the discounting factor. Then up to now, we have discussed calculation of free cash flow. Up to terminal value, we have discussed all things. Now, we have to learn calculations of the discounting factor. As I told you, for the taking present value of the future free cash flows, we need to apply discounting factor. Normally, we use WACC, weighted average cost of capital, as our what? As our discounting factor, because uh, as I told you, then our discounting factor is similar to the required rate of our investors. Investor required rate. Therefore, WACC, weighted average cost of capital, we use as our discounting factor. Then now, I hope to discuss with you calculation of the WACC. Calculation of the WACC. Before moving on to the calculation of WACC, we have to discuss cost of equity and cost of debt separately. Then we can discuss the calculation of the WACC. Let's first discuss the cost of equity. Cost of equity, simply we can say cost of the common shareholders' equity. Then, as the investors, as the shareholders, definitely they have some required return. Then, for from investors' perspective, we can say it as their required return. Then, from company perspective, we can say as our cost of equity. That means, as the fund sourcing method, then we got the funds from equity shareholders. Then, since we got the funds from equity shareholders, we need to pay something to them. Mainly, we have to pay what? Mainly, we have to pay dividends. Then dividends, we can say main cost of our main cost of equity. Okay, main part of we can say dividend as the main part of our cost of equity. Okay, then we need to calculate this cost of equity. Then, like we said, we can't say the only the dividends as our cost of equity. Okay, then for the purpose of calculating cost of equity, there are several methods. Then main world accepted and most usable method is the CAPM model, capital assets pricing model. Capital assets pricing model. Actually, this capital assets pricing model, uh, it was developed based on the some research finding. Okay, actually, it's a well-developed model that we can use to identify the cost of equity. Okay, then let's see, based on the CAPM model, how can we calculate the cost of equity? Simply using the CAPM model, we can calculate cost of equity like this. There is a formula. Then using this formula, actually, it is as I told you, it is a well-developed formula based on the some research. Okay, research and research findings, and some of the researchers are findings. Okay, then let's see how can we calculate this CAPM using this formula. For that purpose, we need risk-free rate plus beta of the company multiplied it by investors required return minus risk-free rate. Simply, we can get cost of equity using CAPM model. How can we get risk-free rate plus beta multiplied by the investors required return minus risk-free rate? Then we can say this difference as the risk premium. We can say this as the risk premium. Risk premium. Difference between the investor required return and the risk-free rate, we can say as what? We can say as it as the risk premium of the company. That means then when we consider the risk-free rate, then here risk-free rate normally we use that country government treasury bonds rates. Government treasury bonds rates based on the our requirement, we can use 10 year, 5 years, 1 year, whatever. Then normally as the risk-free rate, we use what? We use government treasury bonds, treasury bond rates, because risk-free rates mean the returns that we can get without any risk. Then if we invest in the government, definitely our risk is zero. Okay, then it is a zero, then we can't say there is risk if we invest in the government. Okay, therefore as the risk free rate, normally we use government bond rates. Okay, then difference between this investor required return and the government bond rates, we can say as our risk premium that investors expected, because considering the company uh, specific risk, industry specific things, then when we consider these things, most of the cases, investor required more return than the risk-free rate. The difference between the risk-free rate and the investor required rate, we can say as what? Risk premium. Risk premium that they hope to earn from that investment. Okay. Then this risk premium, we need to multiply it by the beta. Beta. Then beta factor is the most important part of our CAPM model. Then risk-free rate, we can directly get it from relevant country, central bank. For example, Sri Lanka, we can get it from Central Bank of Sri Lanka, CBS. Like this, directly we can find the government bond rates. Then investor required return, actually, theoretically we say investor required return minus risk-free rate multiplied it by beta, but actually main part is we need to consider as the risk premium. Actually, the difference between these two things we call as a risk premium. The risk premium we can find based on the company specific things. And other thing is the we need to consider about the other company risk profile and company specific operation. Based on those things, we can decide the risk premium. Okay. Then when we consider the practical situation, then most of the valuation related companies or the valuation advisory service firms, they have their own database that they build to identify the risk premium, country risk premium. Okay, most of the cases we use country risk premium here, but theoretically, as I told you, we need to consider about the investor's perspective about the company. Then based on that, the risk premium can be changed, but practically most of the cases we use country risk premium. And as well as Damodaran, he has also built actually every 6 months he updated each country risk premium. This also we can use for this risk premium, but for your examination purpose, actually your examiner directly will provide the risk premium. Okay, therefore you don't need to think about this risk premium thing, because your examiner will provide. Okay, but practically we need to identify the relevant risk premium based on the company and as well as the country things, and those things directly we can get. But beta factor, not beta factor. This beta factor. Then what is the simple meaning of the beta? Then we can say beta as the volatility or systematic risks of our company in relation to the market. What is the meaning of beta? We can say it as the volatility or systematic risks. Systematic risks of the company or our stock relation to what? Relation to the market, overall market. From beta, as I told you, then I hope you can remember at the introduction part, I told you, not only investor required return we use as our cost of equity. We need to apply it, company specific risk profile, market specific things, those things we need to plug with this investor required return, and finally we can derive the cost of equity. Then here from beta, we try to plug our company specific risks or the systematic risks in relation to the market. We try to plug it into our cost of equity calculation. That is the main purpose of using the beta. Then beta factor. Then beta factor, simple meaning is the volatility or systematic risks in relation to our market, overall market. Then systematic risks mean the risk that is arising from the market condition or the as a outside party. Then also we have unsystematic risks. Unsystematic risks mean the risk that is specifically relevant for the business. Then this systematic risk, it is we can't diversify. Okay, but for the unsystematic risk, that means the risk is specifically relevant for the company, we can diversify based on some our investment strategies. But for the systematic risk, we can't do that. Okay, then these things not important for our calculation, but I told you because it is for information purpose. Okay, then beta, simply we can say it is a volatility. From beta, we measure the volatility of systematic risks of the company in relation to our market. Then beta factor, normally practically we calculate based as the slope or as the correlation between the market behavior and our company behavior. Those things are not important for your examination purpose. If your students engage in the valuation, then they should know about definitely they should know about the calculation of beta. Another thing is we can get beta factor from different databases. We have Definitive, Capital IQ, and also the relevant country. They have their stock exchange relevant website. From this website, beta factor we can get, but based on the situation, we need to decide what is the beta factor that we need to use. Okay, then beta factor, it is an important part of this CAPM model. Then this is the formula that we can use to calculate cost of equity using the CAPM model. This is the most acceptable method because, as I told you, this is a well-developed model based on the past research. Okay, past research based on the finance specialist. Okay, therefore, this is the most acceptable method. And practical also, we use this CAPM model to identify the cost of equity. I hope all of you have an idea with the cost CAPM model. Then other important thing is, as I told you, this beta factor. Then for the public companies, this beta factor, we can take from their website or whatever the database available. We can get the beta factor. But for the private companies or for the startup companies, then beta factor is not available because, as I told you, beta measure what volatility or systematic risk in relation to the market. We need to compare our risks with the market risks. Then based on that, we can derive the beta. Okay. But for the private limited companies, as well as for the startup companies, we don't have beta. Then how can we derive or how can we calculate the beta for like these companies? Because it is important for your examination purpose, because some of the cases I noticed that your examiner told that this company is a private limited company. In like that situation, your examiner gave relevant information to identify our company beta. Then let's see if it is a private limited company or startup company, how can we identify the beta? Then for that purpose, first, we should identify similar public company beta. To derive our company beta, what we need to do first we need to identify the similar comparable public company beta. Public, that means listed company beta. Public company means not on public, actually listed company beta. First, we need to identify similar comparable listed company beta. Then based on this listed company beta, we can derive the what? We can derive the beta of our company. Then for that purpose, we need to consider about their leverage, financial leverage, debt to equity ratio, because this beta factor, it is we can say it is depend on the company. The we can say based on the company leverage, based on the company debt to equity ratio, then this beta factor can be changed. Therefore, we need to consider about our company debt to equity ratio and that selected comparable company debt to equity ratio. Then based on this leverage, then we can derive the beta for our company. Then for that purpose, normally we need to first, then let's assume if I select zero, or if I select the beta for one company, then first I need to remove that leverage impact from that selected company beta. That means simply if it is a levered beta, I need to remove that debt to equity ratio impact, leverage impact, and convert it to the unlevered beta. Then using that unlevered beta, again we can convert that unlevered beta using our company debt to equity ratio, then convert into the our levered beta. Then I have example. I will explain using that one. Okay, this is the way. If you have some, if it is our company is a private limited company, or if we don't have some information for the beta, then we need to calculate beta like this. And other thing is, then as I told you, then from beta, as I told you, it is measure the what volatility or the systematic risk in relation to the market. Then normally beta, it is between, then we can say it is between 0 to, we can see it as the not 0 to, or not 0 to 1, actually it is a 0, then 1, and also less than 1. We can see it as a less than 1 and higher than 1. So we can say, then beta factor we can measure 1, then we can identify the higher than the 1 and less than the 1. Then if it is 1, if our beta factor is 1, we can say exactly our risk is similar to the, or our company risk, or the systematic, our company risk is exactly similar to the our market behavior. Simply we can say our company behavior is exactly similar to the market behavior if it is a 1. But if it is a less than the 1, let's assume it has a 0.8, 0.8. If it is a 0.8, that means our company risk is less than the market company risk. Market risk. If it is a less than 1, we can say our company volatility is less than the market volatility. Then let's assume if market share price decrease 1%, then our share price decrease only 0.8%. That's the meaning of that. Okay, that's the meaning of that. Then if it is less than the 1, we can say our company market share, or the our company volatility is less than the market volatility. But if it is a higher than the 1, let's assume it's 1.2. So in that situation, our company volatility is higher than the market one. Let's assume like this: if market share price is decreased 1%, then our share price is decreased by 1.2%. That's the simple meaning of that. Okay, that means volatility of our company is higher than the market volatility. That is the risk. Okay, actually that is a risk for our company, because uh, if our share price is decreased, sorry, if market share behavior of the market return decrease, then our one decrease than the market one. But if market one increase 1%, then it is positive for us, because if it is market one increase 1%, then our company returns increase 1.2%. It is positive for from that perspective. But when we consider about the from negative, when we consider it from negative perspective, I think it is not good for our company. Okay, then let's simply we can say if it is our beta factor is 1, it is exactly our volatility exactly similar to the market volatility. Then don't need to think about that. But practically we can't identify like that situations. But if it is less than 1, we can say our company volatility is less than the market volatility. But if it is higher than the 1, we can say our company volatility is higher than the what? Our company volatility is higher than the market volatility. Then that is about the beta factor and calculation of the cost of equity using the CAPM model. That's the theoretical background. Okay, then let's say using my hypothetical example, first let's see a calculation of the beta uh, beta factor based on the given details. Okay, then as I told you, then what's the formula that we can use to calculate the cost of equity using the CAPM model? Using the CAPM model, first we need what? Risk-free rate, then risk-free rate plus beta multiplied by the investor required return minus risk-free rate. Risk-free rate. Okay, then here we have details. Our risk-free rate is 10%. Then beta factor is 0.95. Then beta factor 0.95 means what? Then our company volatility is less than the market volatility. Then investor required return is 15%. Then based on these details, we need to calculate the CAPM using the cost of, we need to calculate cost of equity using the CAPM model. Then how can we calculate? Risk-free rate, that means 10% plus 10% plus beta factor multiplied it by difference between investor required return and the risk-free rate. Then our beta factor is 0.95, then multiply it by the investor required return of 15% minus risk-free rate of 10%. Then we can get what? Cost of equity using the CAPM model. 10% plus 0.95, it's our beta, multiplied it by investor required rate of 15% minus 10%. Then we can say this difference between 15% and 10%, this 5% we can say as our what? 5% we can say as our risk premium. Risk premium that investors required for the investing in this company, risk premium, because they expect 5% more than the risk-free rate if they invest in this company. This is a risk premium. Okay. Then simply we can calculate our beta factor 10% plus 0.95 multiplied it by 5%. Then we can get our beta factor as, sorry, our cost of equity using the CAPM model as cost of equity using CAPM model, we can get as 14.75. That means cost of equity of our company, we can consider as 14.75. That means our equity shareholders, they are required rate, in their perspective, we can say their required rate as 14.75. From company perspective, we can say our cost of equity is 14.75. This is based on what? This is based on the CAPM model. This is based on the CAPM model. Okay. Then simply, actually, for your examination purpose, directly your examiner definitely will give risk-free rate, then and the investor required return. Or some of the cases, your examiner directly give risk premium. Okay. Then in this case, you don't need to calculate difference between the investor required return and risk-free rate. Simply, you can multiply this 5% by 0.95 plus 10%. Then you can get our cost of equity as 14.75. Then some of the cases your examiner can give directly risk premium rather than the investor required return. Okay. Then this is about the simple way of calculating cost of equity. Then let's see, as I told you, if our company is a private limited company, as I told you, we need to derive our beta based on the comparable listed company, based on the comparable listed company beta. Then for that purpose, first, we need to select comparable company to our company, and we need to identify their beta and debt to equity ratio, financial leverage, because their financial leverage directly impacted on then actually financial leverage, it is directly impact on our beta. Therefore, we need to identify what debt to equity ratio as well as that company levered beta. Levered beta mean beta that is affected from the debt to equity or the leverage. Then, for example, let's assume our company is ABC PLC, then I identify same company levered beta as 0.87. Then same company levered beta as 0.87, and their debt to equity ratio I identify as 40 to 60. I identify it as 40 to 60. Their debt to equity ratio as 40 to 60. Then they are levered beta. Then levered beta mean beta that is affected from the financial leverage, 0.87. One of these are for our similar comparable listed company. Then let us assume our ABC PLC as a private limited company. Then if it is a private limited company, as I told you, we don't have beta. We need to derive it based on the comparable listed company beta. Then we have comparable listed company beta 0.85, and as I told you, this is the levered beta that levered beta mean what? Levered beta mean what? Levered beta mean beta that is affected from financial leverage or the debt to equity ratio. Then first step is then you need to apply this step. Okay, if you don't have detail for your company beta, and if your examiner give a comparable listed company beta and debt to equity ratio, then you need to derive your company beta based on that details. Okay. Then what is the first step that we need to apply for that purpose? First step is, then we have levered beta for the comparable company. No? Then we need to unlevered. We need to convert this levered beta into the unlevered beta. What's the first step? Convert levered beta into unlevered beta. That means beta that is not affected from the financial leverage. Then we can say it as our equity beta. Then this levered beta, simply we can say it as our assets beta. Okay. We can say it as our assets beta. Then simply this assets beta, we need to convert it to the equity beta. That means if our company slowly finance from equity, then we need to identify the beta. That is the unlevered, simple meaning of the unlevered beta. Then levered beta means if our company finance from debt as well as equity, then based on the financial leverage, definitely our beta affected. Okay, our beta value affected from that debt to equity ratio, because simply we can say if our debt value is increased, then it is directly impact on our beta, because our company volatility can be changed then in relation to the market volatility based on our debt to equity ratio. Then this levered beta 0.87 was the first step. We need to convert into the unlevered beta. Then how can we calculate it to the unlevered beta? How can we calculate it to the unlevered beta? Then this is the formula. Then this one, then using this formula, then simply we can convert this levered beta into the unlevered beta. Simply we can convert this into the unlevered beta. Using this formula, simply we can convert our levered beta into the unlevered beta. Then how can we convert levered beta into the unlevered beta? Then how can we calculate unlevered beta? Levered beta, we can divide it by what? Levered beta divided by 1 plus 1 minus tax rates multiplied it by debt to equity ratio. Then how can we convert our levered beta into the unlevered beta? Levered beta divided by 1 plus 1 minus corporate tax rate or applicable tax rate multiplied it by debt to equity ratio. Then here, let us assume our corporate tax rate as 30%. If you assume corporate tax rate as 30%, how can we convert this levered beta into unlevered beta? Then our 0.87%. 0.87% is our what? It is our levered beta. Then levered beta divided by what? Levered beta divided by 1 plus 1 minus tax rate. Here we assume tax rate as what? 30%. Then multiplied it by our debt to equity ratio of 40 to 60. Then we can get our what? Then we can get our unlevered beta for this comparable company. Then let us assume this comparable company has X, Y, Z. Then we can get the unlevered beta for the X, Y, Z based on this calculation. 0.87 divided by 1 plus 1 minus 0.3 multiplied it by our debt to equity ratio of 40 to 60. Then convert levered beta into the unlevered beta. Then what is the simple meaning of the unlevered beta? That means the beta, if our company is entirely financed from the equity, or on our finance method is the equity finance, then if our finance if we finance 100% from our equity shareholders, then we can say this beta as the beta for our company. That's the simple meaning of the unlevered beta. Then levered beta means, then here our debt to equity ratio is 40 to 60. Then based on this financial leverage, definitely our beta can be changed. Then beta, which is affected from the debt to equity ratio, we can say as the levered beta. Then here we have levered beta for our same company. Then we convert it to the unlevered beta. Then let's calculate our unlevered beta. 0.87 divided by 1 plus 1 minus 0.3 mean 1.7 multiplied it by our debt to equity ratio of 40 to 60. Debt to equity ratio of 40 to 60. Oh, we can't use this one, no. Oh, then we can get our unlevered beta as 0.59. That means if we 100% finance from equity, you can see our beta is 0.59. That means our market volatility, then we can see our market volatility is less. It is less than the if we finance from debt and equity. If we finance 40% from debt 60% from equity, our levered beta is 0.87%. That means our risk is high because it is low. It is almost similar to the market risk, no? Because if it is one, it is almost similar to market risk. Then, if we finance 40% from debt and 60% from the equity, then our BT is 0.87. That means our company volatility is high. But if we 100% finance from the equity, then our volatility is 0.59. That means it is less. It is, then our risk is reduced. No, it is our risk is reduced compared to the if we finance 40% from debt and 60% from equity. Okay, this is the first step. What is the first step? Convert comparable company levered beta into the unlevered beta. Then our second step is, then we can assume then this is a 100% comparable company for our comparable company. Then since it is a comparable company for us, then we can say this 0.59 as our unlevered beta also, because this XYZ comparable for our company. Therefore, if our company also 100% finance from equity, we can say our unlevered beta also should be similar to this one, 0.59. Because this XYZ is a comparable for our ABC PLC. If it is comparable for our company, we can say if we also finance 100% from equity, then our unlevered beta also should be what? 0.5, 0.5, exactly similar to our comparable company. Then we need to adjust this to our financial leverage. That means we need to adjust this for our debt to equity ratio. Then we can identify what? Then we can identify our levered beta. Then our company is actually 100% finance company. Then unlevered beta is equal to the levered beta because we don't have any debt. But if assume our ABC PLC is finance from debt as well as equity. If they finance from debt as well as equity, then we need to convert this unlevered beta into the again levered beta. Then for that purpose, we can use this formula, this levered beta for this formula. That means simply unlevered beta, we need to multiply it by 1 plus 1 minus tax rate multiplied by debt to equity ratio. Then we can convert our unlevered beta into the levered beta. Then here, let's assume our debt to equity ratio, then for my calculation purpose, okay, then our company debt to equity ratio is 45 to 55. Let's assume like this, 45 to 55. 45 to 55. That means 45% from debt, 55% from equity. We finance 45% from debt and 45% from equity. Then if I do like this, then we can convert this unlevered beta into the levered beta using this formula. That means unlevered beta multiplied it by 1 plus 1 minus tax rate multiplied it by the debt to equity ratio. Then our second step is what? Our comparable company unlevered beta convert into levered beta of our company with incorporating our company debt to equity ratio. This is our second step. Simply, as I told you, if our comparable company levered beta 0.59, we can assume if we also finance 100% from equity, then our unlevered beta also should be 0.59. Then we adjust it to our financial leverage. Then we can derive what? Then we can derive our company levered beta. Our company levered beta. We can derive our company levered beta. Then here we can derive our company levered beta based on this formula. That means unlevered beta. That means 0.59. We need to multiply it by. How can we 1 plus 1 minus our tax rate is 30%. Again, multiplied it by debt to equity ratio of our company. That means 45 to 55. 45 to 55. Then simply we can get levered beta for our company. After resolve this one. Then let's resolve 0.59 multiplied it by 1 plus 0.7 multiplied it by 45 divided by 55. Then we can get our levered beta as 0.93. Our levered beta is 0.93. That means it is almost similar to our market condition. That means our volatility is almost similar to the market condition, 0.93. Then you can see, then our debt to equity ratio is 45 to 55. That means we more finance from debt, no? We compare to our comparable company XYZ, you can see when we consider come to the XYZ, they finance only 40% from debt, but we finance 45% from the debt. Therefore, you can see our levered beta is higher than their levered beta. Because as I told you, this financial leverage directly, it is impacted on our company beta, levered beta. Okay, that's the main thing that you need to keep in your mind. Then our beta always, it is impacted from the company financial leverage. Okay, then unlevered beta. What is the simple meaning to unlevered beta? Then again and again, I repeated those things because this is important. If you don't have these ideas on your mind, then you can't do these calculations. Okay, when you can't identify what is the thing that I did here. Okay, then unlevered beta means the beta if our company 100% finance from the equity. Then if we convert this unlevered beta with applying the financial leverage, then we or with incorporating financial leverage impact, then we call this as the levered beta. Then if that company finance 45% from debt, 55% from equity, then our levered beta is 0.93. Okay, then main thing again, and another main thing that you need to keep in your mind, if we finance more from the debt, definitely our beta will be higher. Okay, that's another thing that you need to keep in your mind. Then what is the thing that we discuss here? We discuss if our company is what? If our company is private limited company, or if we don't have relevant details for the beta, then what's the thing we need to do? First, we need to select comparable company, and we need to get their levered beta and the debt to equity ratio. Then after we identify comparable company and their debt to equity ratio, and we need to convert their levered beta into the unlevered beta. Then how can we convert their levered beta into the unlevered beta? Here, levered beta divided by 1 plus 1 minus tax rates multiplied by debt to equity ratio. Then here, our company is ABC PLC, then we identify comparable company for our one as XYZ. Then XYZ levered beta is 0.87. Then debt to equity ratio is 40 to 60. Then I convert this 0.87 into the unlevered beta. Here you can see it as a 0.59. That means if XYZ 100% finance from the equity, their beta should be 0.59. Since our company is comparable to their, then we can assume this 0.59. That means unlevered beta, if that company 100% finance from the equity, it should be equal to our company unlevered beta also, because both of these company are comparable. No? Therefore, if both of the company 100% finance from the equity, then their beta should be equal. Then therefore, we can consider our unlevered beta as 0.59. Then what we need to do? Then we need to convert this unlevered beta into the levered beta based on our financial leverage or our debt to equity ratio. Then we derive our levered beta as 0.93. Then we can use this 0.93 for our cost of equity calculation using the CAPM. Okay, then this will be needed for you to calculate beta if your examiner will don't give the if your examiner will not give if your examiner will not give the beta, and only your examiner will provide, if it is only examiner will provide what comparable company data, then like that situation you can calculate the your company beta using this method. Okay, then Actually, I will discuss more. Yeah, my plan is to discuss more comprehensive two questions. Actually, I think yeah. One question is yeah. Then there is one question. Then this question is we have similar thing, similar scenario. Then here I will more discuss about this calculations. Okay. Then this is about the cost of equity using the CAPM model. Then also addition to the CAPM model, we can use dividend model to identify the cost of equity. Then here, uh, using a dividend model, actually, there are two ways that we can calculate the dividend. If that company is paid constant dividend, if that company pay constant dividend for the future period, then simply we can calculate cost of equity of that company. Cost of equity of that company is equal to the dividend paid because it is a constant, no? Then for each year they pay constant 1 rupee. For each year, 1 rupee, 1 rupee, 1 rupee. Then D0 divided by the P0, that means the market price per share. Okay. Per share dividend divided by the per share market price. Then simply we can get the cost of equity based on the constant dividend model. But issue is this constant dividend model only we can use if it is a matured company and if that company continuously pay dividend, that company continuously pay dividend, and if that company is a matured one, then we can use the constant dividend model. But for the startup company and if growing company, we can't use this dividend model. Okay, then then here we assume that company pay constant dividend, no? But some situation we can say dividend will grow. Dividend will grow based on some rate, based on some growth rate, it will grow. If like that situation, then how can we calculate the cost of equity using the dividend model? Then for that purpose, we can calculate cost of equity equal to the D0 multiplied by 1 plus G divided by P0 plus G. Then using this formula, simply we can calculate the cost of equity if that company pay dividend and this dividend will grow. If it is a growing, then we can use this formula. D0 mean the current year dividend paid, multiplied it by 1 plus G. G mean dividend growth rate divided by P0, current market price, plus G. Then we can get the cost of equity if using the dividend growth model, dividend growth model. Okay, but again, I need to mention this dividend model, we can't use for the startup or the growing company. The main thing is we can use this dividend model only if that company is uh, well-established, mature one, and also if that company continuously pay dividend, then we can use the dividend model to identify the cost of equity. Then, as I told you, the most acceptable method for the any type of the company, we can use the CAPM model to identify the cost of equity. Okay, this is about the cost of equity. Then to calculate the cost WACC, next we should calculate cost of debt because as I told you, then discounting factor, it is not only it is not about the equity shareholders required return. We need to consider about our debt holders required return, or from our perspective, we need to consider about the cost of debt. We need to consider about what? We need to consider about the cost of debt. Then simply we can calculate cost of debt. How can we calculate the cost of debt? Our interest rate, we pay some interest, no? Then interest rate multiplied it by 1 minus t, because for the interest expenses we have what? Tax benefit, no? Then interest expenses are tax deductible. Therefore, we need to incorporate that benefit into our cost of equity calculation. Therefore, we can calculate cost of debt. How can we calculate interest rate multiplied it by the 1 minus t? Then let us assume for my hypothetical scenario, then let's assume our bank loan borrowing rate as 12% and our corporate rate tax rate as 30%, then simply I can calculate cost of debt as I told you 12% multiplied it by 1 minus 0.3. 1 minus 0.3. Then we can get the cost of debt. We can get the cost of debt. 12% multiplied it by 1 minus 0.3. Okay. Then here we can calculate 12% multiplied it by 0.7. Then we can get our cost of debt as 8.5. 4%, 8.4%. Then our cost of debt is 8.4% based on the given detail. How did we calculate it? 12%, that means bank loan borrowing rate multiplied it by 1 minus our corporate tax rate. That's a simple way that we can calculate the cost of debt. Cost of debt. Okay, then that's a simple thing. That's a simple thing. Simply we can calculate cost of debt using this formula. Okay, then let's see calculation of the WACC, weighted average cost of capital. Then if we have cost of equity, then if we have cost of debt, as well as we should have market value of the equity as well as market value of the debt. Then we can calculate what? Weighted average cost of capital. Then simply we can calculate the weighted average cost of capital. Then let's see how can we calculate the weighted average cost of capital. Then here our cost of equity is 14.45. Then our cost of equity is 14.75. Then our cost of debt is 8.4. 8.4. Then our cost of debt is 8.4. Then we need to weight it cost of equity and cost of debt based on what? Based on the market value of the equity and market value of the debt. Then let's assume our market value of the equity as 150. Then market value of the debt as 100. Then we can identify the weight equity as from the total 60%. Debt we can identify as the 40%, no? 40%. Then our equity is 60% from our total fund finance, and debt 40% from our total fund finance. Then 250 is our total fund finance. From this, 60% is equity, 40% is debt. This is our, simply we can say this as our finance, our debt to equity ratio, 40 to 60. Okay, then 40 to 60, we can say our debt to equity ratio as 40 to 60. Then based on this 60 to 40, we need to weighted this our cost of equity and cost of debt. That means simply our equity portion is 60% and our debt portion is 40%. No? Then simply 14.75, we can multiply it by 60%. We can multiply it by 60%, and 8.4 of our cost of debt to equity, we can multiply it by 40% of our debt portion. Then we can get these value. These are the weighted cost of equity and cost of debt. And finally, summation of these two things, we can identify as our what? WACC. We can identify this as our what? This as our WACC. This is the WACC for our company based on the available data. This is the WACC for our company. Then actually WACC calculation, it is not harder things, okay? Based on the market value of the equity, based on the market value of the debt, simply we can calculate the WACC. I think all of you have, I hope all of you have idea about the calculation of the WACC. Then this is a simple way that we can calculate the WACC. Okay, then this WACC we can use for what? Then this WACC we can use to calculate the present value of all of these cash flows. Okay, present value of all of these cash flows. Then here, let's assume if our WACC has 14, how much? 12.21. If it is a 12.21, then our discounting factor we need to identify for 12.21. Then here we calculated our discounting factor at 12.21 like this, and then we can multiply our cash flows by this discounting factor, and finally we can get what? Finally we can get the present value of all of these cash flows like this. From 2025 to 2023, we can get the present value of all of these cash flows based on the WACC of 12.21. Actually, now we have calculated the present value of all of these cash flows. Then most important thing is summation of all of these cash flows. Technically, we call as the enterprise value. Technically, we call as what? Technically, we call this as the enterprise value. Okay, then my next topic is about the enterprise value versus equity value. Then let's see it from our next part.